Something just broke in the bond market, and most people are not paying attention. Let me explain. The 30-year Treasury yield just broke 5% for the first time since 2007, right before the great financial crisis started. This has a direct impact on the economy, the stock market, and your paycheck, but most people have no idea what a Treasury is, let alone how it actually impacts the broader economy. And that is why in this video, even if you do not know what a Treasury is, I am going to break down what is going on, but more importantly, what might be coming. That way, not only you can protect your money, but also find the opportunity, because this change can create the opportunity for you to grow your wealth even faster. So let me break it all down. Imagine for a second that you have a $500,000 mortgage at a 2% interest rate. So your monthly payments to your bank are around $1,850 a month. Well, your bank calls you up one day and they say, hey, we need to readjust your mortgage. You are no longer going to be paying this 2%. Now we are going to charge you 5%. And now overnight, your mortgage payments go from $1,850 a month all the way up to about $2,700 a month. That seems a little crazy. Well, this is exactly what is happening to the United States government right now in the Treasury market. The way the United States government works is they go out and they collect tax dollars from people like you and me, and then the government will go out and spend this money in our economy. They spend this money on things like Social Security, Medicare, and our military, and then the infrastructure for the country. The problem is that the government spends way more money than what they generate from taxes. This is not a 2026 thing. This is something that has been happening for decades. And so to make up for all of this additional spending, the government has to go out and borrow this money in the form of debt. Well, during the 2020 pandemic, it is becoming apparent that the government made a big mistake in the way that they were borrowing money. When the United States government borrows money, this is called a treasury, and you can lend money to the United States government yourself. And in exchange for lending money to the government, they are going to pay you back your money plus interest over a period of time. Now, sometimes these loans that the government will issue are short-term loans, things like a few weeks long, 1 year long, 2 year long, 5 year long. Sometimes they are longer-term loans, 10-year loans, or 30-year loans. Well, this is where the government made a very costly decision, but to really understand what they did, let us ignore the government for a second and go back to you buying a house. If you go out and get a mortgage for a house, generally you are going to get a much lower interest rate mortgage when you get a 15-year mortgage versus a 30-year mortgage. Because with a 15-year mortgage, the bank gets the money back faster, so they charge you a lower rate of interest. Well, it works the same with treasuries. When the government borrows money for 1 year, they are going to pay a lower rate of interest than when they borrow that money for 30 years. So let us go back in time, back to the year 2020 and 2021. Remember, that was when we had the lowest interest rates in the history of time. And now the United States government was deciding what type of loans they wanted to issue, short-term loans or long-term loans. And this is what their options were. So it is the year 2020 and 2021, and the United States government is borrowing more money than ever before. Part of the reason why the government is borrowing so much money is because they are funding stimulus checks, they are funding unemployment checks, they are funding these PPP loans, they are bailing out businesses. I mean, the government is borrowing more amount of money than really most people can imagine. And this is where the government had to make a decision. Did they want to lock in a 30-year fixed rate loan, meaning the government would be paying out this amount of interest rate for the next 30 years locked in at something like around 2% a year? Now, I am estimating here because the interest rates did change between 2020 and 2021, but around 2% a year. Or did the government want to get a little bit more aggressive? We can lock in a 10-year fixed rate loan for something like 1.5% a year, which also was some of the lowest 10-year loans in the history of time. So the government could save some money by getting a 10-year loan, but it is not going to be locked in for 30 years. It will only be locked in for about 10 years. Or did we want to get even more aggressive and maybe get a 5-year loan or a shorter term loan and now only pay something like a 1% interest rate, but it is not going to be locked in for 10 years or 30 years. It will only be locked in for about 5 years, kind of like an adjustable rate mortgage, where now your mortgage rate is not locked in for 30 years. This was the dilemma that the government was facing back in the year 2020 and 2021. And during the time when interest rates were so low, the government was borrowing money like crazy to fund PPP loans and unemployment checks and stimulus checks and everything in between, and the government said, you know what, instead of locking it in for 30 years at 2% a year, how about we just do these 5-year loans? We are going to do more of these 5-year loans at this very cheap interest rate because we will get to save more money on our interest payments today. Well, here we are now 5 years later, and now this government debt is starting to readjust at a much higher interest rate. Now, for those of you that were watching my videos in 2020 and 2021, we were talking about what would happen once the government debt starts to readjust in the coming years. Well, here we are today, and now many people are starting to call it the biggest blunder. In the history of the United States Treasury, we had the ability to lock in our interest rates for decades at some of the lowest interest rates in the history of time. Instead, we decided to do these short-term loans to make the most money in the short term, having the short-sighted mindset. And now, well, things are about to change. In 2024, about $7 trillion of government debt debt readjusted at higher interest rates. In 2025, it was about $9.2 trillion that readjusted from this era to the higher interest rates in 2025. And now in 2026, it is estimated that about $9.7 trillion is going to readjust at the higher interest rates today. Well, the real issue in 2026 that was not there in 2025 or 2024 is that the interest rates that the government has to pay today are even higher than where we were last year. I know I keep going back to the housing market example, but the people that were buying houses in the early and mid-2000s, they also did not know what was going to happen to interest rates. So your mortgage banker said, hey, interest rates are probably going to come down, and when they come down, you can just refinance your mortgage at a lower rate, and things will be fine, and you will be able to save money on your mortgage. Well, that did not happen. Mortgage rates went up, not down, and that is what caused the housing market to collapse come 2008. Well, here we are today in 2026, and leading up to 2026. Everybody kept thinking that interest rates are going to fall, that the Federal Reserve Bank is going to cut interest rates aggressively. But then a lot of things changed in the economy. Oil prices skyrocketed. We entered a new war in the Middle East, and now interest rates are the highest that we have seen since 2007, right before the housing market collapsed in 2008. The other part of the problem is that the previous people that would lend money to the United States government are not lending money to the United States government the way that they did before. For example, China is one of the largest owners of United States debt, and they have turned from a net buyer of United States debt now to a seller of United States debt. We also have many other countries around the world that are not buying as much United States debt because now they want to buy gold because they are worried about the United States dollar. They are worried about inflation, so the way that the United States government can borrow this money is starting to change. And if the government cannot borrow this money from people like you and me, they cannot borrow this money from foreign countries like China and Japan and the United Kingdom. Then the third option is the United States government will either have to find an alternative solution. I will talk more about that in the coming days. Or the United States government is going to have to work to get that money printed through the Federal Reserve Bank. Remember, the Federal Reserve Bank is the central bank here in the United States, but they are not a bank because you and I cannot go there to deposit money. They are not a reserve because they are not sitting on any cash reserves, and they are not federal. It says so on their website, but they have the ability to print money and lend it to the United States government. So if the government keeps spending money that they do not have, which looks like it is going to continue happening, and they have to continue refinancing their debt, they are going to continue needing more lenders. They are going to continue needing more buyers of this debt. And if there is not the same demand as before, that is where the Federal Reserve Bank has to step up. They have to print the money and then lend it to the United States government. The problem with that money printing is, of course, money printing comes with more inflation because you cannot print more wealth. You can print more dollars, though, and as you print more dollars, the value of each dollar starts to go down, causing the prices of things to go up. Now, couple of that with the higher oil prices. Couple that with already the high inflation that we are seeing today in 2026, and you can start to see the problem. But there is one more part to this that you want to pay attention to. Do you want to know what the fastest growing expense for the United States government is? It is not our military, it is not Medicare or Medicaid, and it is not Social Security. It is interest payments on all of our debt. Why are interest payments? Well, two reasons. Number one, the government keeps spending trillions of dollars that we do not have, so we keep increasing how much debt we have to have. But also number two, because as we refinance this debt, as our debt comes due, this debt is now being readjusted at these lower interest rates to now some the highest Treasury rates that we have seen in about 2 decades. Now let me explain why that matters, because right now at the time we are recording this video already, every time you give $1 to the United States government in taxes, 20% of that, about 20 cents of that dollar, is going just to pay interest on the previous debt. It is not going to pay for your health insurance, it is not going to pay for any infrastructure, it is not going to actually provide value for you. It is just going to pay off the previous debt. As interest costs start to go up even more, that puts more financial strain on the United States government, that more and more of our tax dollars have to be used not to actually provide value to its citizens, but to be used to pay back the previous debt plus interest. That is the problem that the government is facing. We keep spending money that we do not have, and now we also have higher debt costs, and as our debt costs also go up. Now the government gets into a tougher situation. Are we going to raise taxes? Which it does not look like we are going to do because President Trump just signed the biggest tax cut bill that we have seen in the last 300 years. Are we going to cut spending? Well, people do not like the idea of cutting spending on Social Security or cutting spending on Medicare or cutting spending on our military. So if we are not going to cut spending and we are not going to raise taxes, what is the alternative? Well, we can print that money, but now we have an inflation problem. And this is where a lot of people do not understand how this inflation works. But the inflation makes the average person poorer while the investor becomes richer. That is why you have to understand how this system works, because this is happening right now, and most people do not know the implications of these higher interest rates. But these higher interest rates have a direct impact on our economy. They have a direct impact on the stock market, but they also have a direct impact on your paycheck. Because it changes the value of your paycheck as inflation happens. Your paycheck buys you less stuff, your savings buy you less stuff, and that is why it is so important for you to understand this, because most people do not start paying attention until after the fact, after they start feeling the impacts of this on their wallet, after they start seeing the impact of this on the stock market, after they start seeing the impact in the job market and the economy. Well, this is where I want you to get a little bit more proactive and understand that, hey, there are changes happening. I am not saying be worried about a recession or a market crash. Those things are always on the horizon. It does not matter when we are talking, they are always on the horizon. I want you to understand that the way you become wealthy in this system is by becoming an investor. But it has just become exponentially more important. Why? Because all of this is going to lead to more printing. More printing means more inflation. More inflation means investors become wealthier. The average person becomes poorer. Now, it does not mean we are not going to see a market downturn. It does not mean we are not going to see a market crash. Those things are very possible. But they create even better and bigger buying opportunities to invest your money. But you have to be in a position to invest your money. This is what you have to understand. We are going to see a bigger divide between the rich and the poor. Because as you print more money, inflation means that the average person has paycheck now buys less stuff and the prices of things go up. Now, you might say, well, paychecks go up with inflation. Yes, they do. But what we have seen, not just over the last 5 years, but over the last 50 years, is that paychecks have not gone up fast enough to keep up with the prices of things. So if you want to win in this system, it has just become exponentially more important for you to become an investor. Why? Because the government debt is going to get even more expensive. And unless we see a drastic change in interest rates tomorrow, which sure, is it possible? Anything is possible. But based off of what we know today at the time we are recording this video, as this debt starts to mature and it readjusts, government expenses are going to go up. As government expenses go up, they are going to need more money to continue spending all of the things that they want to spend money on. And if they do not have the money to do that, that means more printing is going to happen. As more printing happens, that leads to more inflation in the economy. That is what you want to understand, because that inflation makes some people richer, but it makes everybody else poorer. That is why you want to understand this. That way you can capitalize on what is happening instead of being blindsided on what is happening. If you got value out of this video, the best thank you is a referral, so if you could, please share this video with a friend, family member, colleague, or fellow investor. That way we can continue to spread this type of financial education. Thank you.